CIA, inflation, the next threat, asked Dr. Juan Castañeda and Professor Tim Congdon in an IEA briefing paper back in, feels like a long time ago, in June 2020. In that paper, you warned, and I quote, "By mid to late 2021, the pandemic should be under control, and a big bounce back in financial markets and in aggregate demand and output is to be envisaged. The extremely high growth rates of money now being seen, often into the double digits, at an annual percentage rate will instigate an inflationary boom." Now, of course, inflation has now taken off, with the CPI index reaching over 5% in the UK, a similar level in the Eurozone, and 7% in the US. I'm joined today by both Juan and Tim, who are the director and chairman of the Institute of International Monetary Research, who wrote that briefing paper. I'm sure you have a lot of reason to say, I told you so, and we're going to get to that in just a second. But I'm just going back to the basics here, since we really haven't had much of a discussion about inflation, particularly someone of my generation. We haven't really had much idea of it, and we haven't lived through the kind of inflationary booms of previous generations. So I'm just thinking kind of, what is inflation, and why does it matter? Why is this going to be such an important issue?
I'm a bit older than Juan, so perhaps I'll take this up. I lived through I was born in 1951, so obviously I lived through the 60s, 70s and 80s. And I started work on the Times as an economic journalist in 1973. And it was a wonderful time because it was economic chaos. So wonderful as a journalist to reporting on chaos. Anyway, inflation in Britain peaked at 27%, over 27% in, I think it was summer of 1975. And I spent my early years as a journalist on the Times reporting on all this. It was a very difficult time. House prices were unstable, strikes, not very much economic growth. It was a mess. And one of the achievements of public policy over the next 15, 20 years was actually to bring inflation under control, so that really in the British case, from the early 1990s, we had a really stable period from, say, 1992 to 2007. And even since then, inflation has been under control until, 2021 and 2022.
For a lot of people, Jan, I think it's trying to understand how this is impacting their personal lives. We've seen some recent data in the last couple of days from the ONS suggesting that inflation is well above our increase in wages. So in real terms, we're worse off, I suppose, might be the way to put it. Do you think that there is an ideal level of inflation, that the Bank of England's target is meant to be 2% year to year? Does that feel right to you?
Well, may I just come back to your first question, if you don't mind. Inflation is caused by an excess in the amount of money as compared to the rate of growth of real goods and services in the economy, real GDP. And that's precisely what we have seen in the last few months, especially since March 2020. So it's been a dramatic increase in the amount of money, surge in money growth, not only in the US, but also in the UK and in the Eurozone. That's why we are seeing the surge in inflation in recent months. But to address your second question, it's very important for the economy, because the higher the rate of inflation, the lower the real purchasing power of people's incomes. And eventually, as it has started to happen, when interest rates start to increase, that will be affecting, obviously, mortgage payments. And that's something that we will see in the UK in the next few months.
Going back to what you predicted, I suppose, why were you right in your prediction and everyone else was wrong back in 2020? We had a lot of sense that we were in an era of unprecedented monetary policy, that we were going to have low inflation or deflation for years to come. Certainly when you wrote this in June 2020, I don't think any central bank was predicting forthcoming inflation. What was, in fact, driving inflation and what is driving our current high levels?
Well, can I just, Juan is right. Inflation is caused by excessive growth of the quantity of money. So what we do at the Institute of International Monetary Research at the University of Buckingham is to monitor what's happening to the quantity of money month by month. It's a regular process. And so what we had, the USA is really the villain of the piece here, I'm afraid. The USA had, in the 4 months from March to June 2020, an increase in the quantity of money of 19% in that mere 4-month period. In other words, if that had carried on for a year, we'd be talking about the quantity of money rising by almost 70% because of the compounding. Now look, you can't have that rate of money growth and not have inflation to follow it. What in a way is staggering about what's happened in the last 18 months, 2 years, it's getting for 2 years now, is that we took this view in the spring of 2020, we have been right, and central banks and other economists just didn't see it at all. And that was because they don't look at the quantity of money. It's, in a way, it's as simple as that. You then ask, what is it that these economists do? Well, I'm afraid their models are useless.
What are their models? Why has the kind of monetary theory that you're espousing, I guess, the Freemanite perspective about inflation and monetary policy, how did that kind of fall out of popularity? And you've got kind of a new Keynesian model with it's certainly a different idea about what's driving inflation. What I suppose went wrong in the intellectual sphere that led to that result?
Juan, you want to pick up on that, or okay?
Yeah, I can start and then perhaps
Okay,
I can follow it
yeah,
up. Our approach is very much what is called the monetarist approach to inflation, that links excessive money growth to inflation over time. One of the reasons why I think that monetarism was very criticized in the aftermath of the global financial crisis, 2008 to 2010, is because at that time, the Bank of England and other central banks implemented QE programs, asset purchases from the central bank to the banking sector in the country. But that was reflected in an increase in bank reserves at the central bank, not in the amount of money in the economy, broadly defined. So that's the reason why back in 2008, 9 and 10, QE was not followed by inflation. What it has happened since March 2020 is quite extraordinary. Yes, QE has affected both bank reserves at central banks, but also bank deposits, which is the bulk of the amount of money in circulation in the economy. That's the reason why this time it has been inflationary. But to answer to your question, quite many people discredited monetarism because it did not, in their eyes, follow to inflation back in 2008, 9 and 10.
I agree with what Juan has just said. I think one of the problems here, and it's not just the sequel to the Great Recession, it also goes back to the 1970s and 80s, is the question, there are several different definitions of the quantity of money, and which is it that really matters? And our answer is it's always a broadly defined measure of money. We don't look at narrow money. We don't draw any conclusions from.
And so what's the difference between narrow and broad money?
Broad money is a measure of deposits that includes time deposits. Essentially, it's more or less equal to all of the deposit liabilities of the banking system. There are some qualifications of that, but that's more or less what it is. Whereas narrow money consists of only sight deposits. It's deposits you can make a payment against now, not deposits that have got some period to run. This debate goes back a long way, but for me, one must always use a broadly defined measure of money. I think one other thing to say here is that the subject is a mess, and in the last few years, you've had some people equating monetary policy with the size of the central bank balance sheet. So again, it's a terrible mistake. As Juan did some work showing that the size of the central bank balance sheet in the very inflationary 97, 1980s basically didn't decrease at all. It's always a broadly defined measure of money, including all bank deposits, that really counts. That's a crucial message to get over. All of our work is of that sort.
And what was really extraordinary for us to observe back in the spring 2020 is that central banks were conducting QE operations, asset purchases, to a greater scale actually, even larger to what happened a few years before during the global financial crisis. And they didn't seem to pay any attention to the effects of such policies on monetary growth. So they were not in a position to anticipate inflation just because they did not incorporate monetary analysis into the
I
analysis of
think the
inflation.
Bank of England, just after the Great Recession back in 2009-2010, certainly did make an allowance for money growth. In those days, they carefully calibrated quantitative easing so that it would be consistent roughly with 5% growth of broad money. They didn't say it's too loud in public, that's actually what they were doing. And so at that time, QE was very clearly related to quantitative money. My view, QE was necessary then, it was a success. What's happened in the last 18 months or so with these vast QE operations, asset purchases by central banks, was not necessary on that scale. It's been a disaster.
I mean, what I found quite extraordinary and underreported was the extent to which the central bank was effectively buying bonds, albeit on the secondary market, they were government bonds. So effectively, but quietly coordinating with independent central banks who were effectively coordinating with government to enable them to do all that kind of COVID spending. I think a counter argument here from people who might be a little more sympathetic to the central banks is, well, effectively they had no other choice. We were in state of emergency. If they didn't do this, there was going to be a huge collapse in spending capacity in the economy. The governments need to step in fiscally in order to spend that cash on various COVID support schemes. The central bank was also responsible in the way in which they stepped in order to ensure that there was the money supply necessary for the government to do that.
I think in the immediate aftermath of the announcement of the emergency, which in most countries was in March 2020, it was like a war. There's a lot of the top policymakers used that analogy that it was, like a war. And it was about saving lives. So in those circumstances, the central bank has to help the government, because you can't have central banks being accused of being, cheap and cheese-paring, and they've got to help the government. And but when you get, fair enough. In the early, it was about helping to deal with an emergency that was leading to mortality. But let's just be clear: what happened in the United States was that they had this sort of 19% growth of broad money in that 4-month period. Then in the second half of 2020, rather curiously, money growth collapsed. There was a period when there's hardly any money growth in the second half of 2020. It was very odd. And then what you had in last year was a re-acceleration of money growth. Look, the point is they just don't think that the rate of growth of money matters to anything. For me, this is just shocking. And can I just say, what fools they've made of themselves?
Mm.
Yeah, well, effectively, and I agree with Tim, effectively with the Federal Reserve to a large scale, but also other central banks to a lesser extent, they have been monetizing enlarged deficits by governments. And fair enough, as Tim put it, in the very short term, in the very aftermath of the crisis, of the COVID-19 crisis, you can claim that it was necessary. But what we do criticize in our report for the IEA is the scale of that support, and also that it was very short-sighted. They should have noticed the medium to long-term effects of such policy, and they should have stopped it much earlier.
In a sense, that the modern monetary theorists are right that the central banks can monetize government debt.
A little bit. There's a curious pattern in the USA. They did stop it for a period.
Yeah.
In the second half of 2020. There's no announcements about all this, but they did stop it for a period. And then it resumed in 2021.
Yeah.
And the real point is that they aren't thinking about the connection between money on the one hand, they'll tend to open market operations, the banking system, that leads to money growth, then that affects the economy. They just don't think in these terms at all.
Yeah. I think for those outside of this room, this conversation will be quite foreign, because in the news media in the day-to-day when we hear about inflation, rarely, if ever, do we hear about monetary supply. Occasionally we might hear about interest rates, but really the most of the discussion, I think, is focused on the supply side facts of COVID, the way in which shutting down the global economy has had the unintended consequence on global supply chains, whether it becomes energy and oil and gas, or be it transport, or be it things like taxes the government's putting up. And that's where we hear things about the great squeeze, the cost of living crisis. We don't seem to hear much necessarily about monetary policy. I was wondering, I suppose critics of your worldview might say, well, actually what's going to happen very shortly is more or less that the economy will respond dynamically increase the supply, things will get back to normal, and we won't have a particular issue with inflation for much longer. This is, of course, the transitory view of inflation, that it's just a short kind of inflationary shock as we deal with the consequences of the global economy being kind of out of alignment after the shutdowns that we saw. What would you say to those people who kind of, I suppose, more focus on the supply side and the energy prices and whatever else?
Do you want to pick us up, or shall I go? Okay, I mean, every price change will have a supply element in it. That's obvious. Prices are set by supply and demand. You can't explain movements in absolute prices, but the whole price level, in all prices, by what's happening to particular supply curves. What matters for the whole price level is the supply of that which is not goods and services, that which is money, all right? And on this particular front, let's just be clear that in this cycle, we have seen enormous increases in share prices and house prices. Please, can you explain increases in share prices and house prices by supply-side bottlenecks? Don't be so silly.
And I could definitely explain increasing house prices by planning bottlenecks and
you can't. Sorry, you can't. Because you have, if you look at a period of time, you have some years house prices are falling, other years they're rising. The planning regime is there as a fact all the time. You can't explain changes by something that's going to be affecting the level. This is a point that Milton Friedman made, by the way, in the 1970s when I came to the IEA to talk. He always said, is trade union power responsible for inflation? He said trade unions affect wage levels. They affect the distribution of income between factory owners and the trade unions, if you wish, but they don't affect inflation rate because trade union power is relatively stable. Inflation fluctuates. So I'm sorry, no. What's happening is in the US and the UK, a lot of house price inflation at the moment, which is to be attributed to, again, excess money growth and also the fact that some people have made money on the stock markets, putting into houses, that kind of thing. You can't explain what's happening to asset prices in this cycle by supply-side bottlenecks. Can I just say one more thing? In the United States, you've got President Biden saying he's going to spend government money to improve the supply side of the economy and to end these bottlenecks. He is doing, this is exactly what is wrong. What economists are supposed to do is to identify the true causes of something and to say that the way to deal with it is to deal with particular supply side bottlenecks. No. The answer is to control the quantity of money.
There is a problem here between what are the manifestations of inflation, if you like, and the real causes of inflation. And I do blame central banks for this poor understanding of inflation, I think, because of how they explain the monetary policy decisions. So, yes, the manifestation of inflation may be through an increase in commodity prices and energy prices and so on. But the real causes of inflation, you have to look into what has happened beforehand, a few terms earlier, in the amount of money created in the economy.
And I think on that note, I'm interested in your predictions, I suppose, where inflation is going. If you can see from what's previously happened with the growing supply of money, gives you a good idea of future inflation, like it certainly did in your June 2020 report. How long do you think we're going to see the kind of, I suppose, 5% or above 5% inflation for? Are we talking 2-3 years, 5 years, 6 months?
Well, perhaps I'll talk about the States and the UK, and then Juan, who's Spanish by background, talk about Europe a bit. So, although there, and perhaps also East Asia, because they're all different parts of the world. As far as the United States is concerned, the quantum rate went up by over 8% in 2019, 22% in 2020, and 10% or so last year. Because of compounding, that's an increase of about 45% over 3 years. So that is far in excess of the trend growth rate of real output. And it seems to me quite possible that inflation in the USA at some point in the next couple of years will reach 10%. Obviously, I can't make a categorical forecast. Things do, and the quarter-by-quarter profile is indeed affected by energy prices and things like that. But it's at a high risk of double-digit inflation. In the UK, the numbers weren't as bad as that, but I would say we're going to have 5 to 10% inflation for another couple of years. We're a lot dependent on what happens to monetary policy and money growth in 2022, which will be affecting 2023 and 2024. I can't look out to 25 and 26. It's too far ahead. But I also think it's going to be very difficult in the USA and the UK to get inflation back down again without a recession.
What is going to happen in 2022, according to our analysis, is very much a result of the mismanagement of monetary policy in the past, in the last 1 to 1.5 years, both in the UK and the US. In the Eurozone, there is also an inflation problem, but I'm pretty sure Tim agrees with me when I say that they haven't, the excessive money balances in the Eurozone hasn't been as bad as in the US. So they will suffer from inflation in 2022, but it's not going to be as radical as in the US. So what will happen later in 2024 and beyond will very much depend on how the central banks react to the current inflation episode. A precondition for the economy to return to 2% rate of growth of prices, as stability as they define it, is for the rate of growth of money, broadly defined, to stay around 4%. So if they manage to do that, they will contain the inflation episodes in the forthcoming years.
I suppose in that leads to the next question, which is, what do you think the likelihood of the central banks kind of following the policy prescription that you've suggested and tightening up, and what else needs to be done? Is NQE put up interest rates? Expect there to be some kind of economic consequence of that's negative, but in order to stop
again,
inflation.
perhaps Juan can pick about Eurozone. I'll just about the USA and the UK. I think I'm relatively relaxed about the UK, in that I think in the UK we have we went through very bad inflation experiences in the 1970s, 1980s. There is memories of that period and how it was dealt with by the Thatcher government. And I think that, in fact, we won't have continuing inflation through into the mid and late 2020s at these very high rates. I'm very worried about the USA, essentially because it's a kind of intellectual vacuum. As I said, the Federal Reserve just simply doesn't follow these numbers at all. And I don't know what's going to happen there. I just don't know what's going to happen, I have to say.
In the Eurozone, the Eurozone is committed to maintaining prices around the harmonized index of consumer prices, as they call it, to keep it around 2% over the medium term. What the ECB has announced is that they will discontinue one of the QE programs they are developing at the moment, and they will keep the other one. And they think that inflation is going to be transitory, will go back to something more normal by the end of the year, and indeed in 2023. If we are right with our forecasts, they will have to tighten policies much earlier in 2022.
And do you think they're likely just to tighten the policies as a matter of the facts of the inflation?
Yeah.
The system, more or less, I suppose the semi-independent central banking system and their targets and mandates will force them, even if perhaps too slowly, to pull those the money supply back and increase interest rates.
Yeah, they have to do certain things to affect the quantity of money, and just some of the mechanics. In the asset purchases of the last 18 months have been the central bank comes along and gets some money from the commercial banks, it's credited into the commercial bank's cash reserves, and then the central bank buys assets from the non-bank private sector, which increases the bank deposits held by the non-bank private sector. And that's the key mechanism behind the 20% plus growth of money in the US and almost 15% in the Eurozone and 15% in the UK at the peaks. The way to reverse that, of course, is actually for the central banks to sell, sort of buying to sell the bonds that pay. The risk, I would just mention this, is that they do this without looking at what happened to the quantity of money. They just do it because they say that's what caused inflation, we're going to stop it by selling these things. And what they do is cause the quantity of money to start falling rapidly, and then you get a bad recession. And I don't want that.
Of course, what this episode has demonstrated is the enormous power central banks have to create money in the economy. This is something that we observed before COVID-19 crisis, Tim, this debate about the lack of ammunition of central banks to affect the economy in an environment of very low interest rates. Well, it happens that they do have the power to create as much money as they wish, for better or worse, and now we're seeing the consequences of it.
Well, it looks like monetary policy is back, inflation is back, interest rates are back, and I think we're going to have a very interesting 2022, and I'm sure based upon your past kind of successful predictions, you're going to be very much in demand in the coming 12 months. Thank you very much, Dr. Juan Castañeda and Professor Tim Corrigan for joining us here today on the IEA YouTube channel and for your continued contributions to these debates.
Thank you.
Thank you very much.
Well, if you enjoyed that conversation, why not watch one of these other videos? And while you're here, remember to hit the subscribe button and the notification bell. That way, you'll never miss out on a single IEA broadcast.